Today, I am tasked to discuss the illustrative audit case 13.1, which is an audit of property, equipment, and related depreciation and accumulated depreciation accounts. In this case, we're going to examine Havens Corporation financial statements. And first, I'm going to show to you the Havens Corporation, their analysis of their property, plant, and equipment, and related depreciation and accumulated depreciation accounts for the year ended December 31, 2017. So these are their descriptions, their amounts, and their corresponding balances. So in examining, let's try to consider the following. First, all plants assets are depreciated in a straight line basis with no residual value, and the estimated service life of a building is only for 25 years and 10 years for all other items. Let's also take note that the company's policy is to take 1.5 years of depreciation of all assets addition and disposals during the year. In this problem, we're required to prepare adjusting journal entries that we propose at December 31, 2017 to adjust the accounts to all the transactions that I will give later and disregard income tax implications. All the accounts has not been closed, and all computation should be based or should be rounded off to the nearest peso and use a separate journal entry, adjusting journal entry for each information. The examination of 2017 transactions revealed the following information. First, on April 1, the company entered into a 10-year lease contract for a die casting machine with annual rental of 5,000 payable in every April 1. The lease is cancelable by either party, and there is no option to renew the lease or buy the equipment at the end of the lease. The estimated service life of the die casting machine is 25 years with no residual value. The company recorded the die casting machine in the machinery and equipment account at 40,400, the present value at the date of the lease, and 2020 applicable to the machine has been recorded has been included in the depreciation expense during the year. For solution number 1, first entry is prepaid rent, which is equal to 1,250 because it is stated that every April 1 there should be an advance of 5,000. So take note, this is for the year ended December 31. So from April 1 to December 31, 9 months siya. So mo na imong nagamit sa imong gi-advance nga 5,000. So the remaining would be 3 months because 12 months minus 9 months nakay remaining nga 3 months. So mo na panay imong wa nagamit so sa imong gi-advance nga 5,000 for 1 year. So to equate the prepaid rent, 5,000 divided by 12 months times 3 months remaining sa imong pa nagamit is equal to 1,250. Another debit account is the rent expense. So as what I have said earlier, 9 months nga managamit from April 1 to December 31, so that is your rent expense. So to equate, 5,000 divided by 12 months times 9 months is equal to 3,750. So that is your rent expense. Another debit account is the lease contract payable, which is 35,400. So by simply deducting 40,400, which is the amount of the die casting machine that was charged to machinery and equipment, minus the advance rental, which is 5,000. In the first information, we can observe that there is an amount of 2020 that was erroneously recorded or included in the depreciation expense for the year So to correct or to adjust, you just simply reverse the original entry or how it was recorded. So now it would be accumulated depreciation, which is originally a credit account, amount to 2020, and depreciation expense for the credit account, which is originally a debit account or normally a debit account, which is 2020. Second information, the company completed the construction of a wing on the plant building on June 30, but the service life of the building was not extended by this addition. The lowest construction bid was 17,500 and recorded in the building's account, and the company personnel constructed the addition at the cost of 16,000, namely materials 7,500, labor for 5,500, and overhead cost for 3,000. For information number 2, in this case we can observe that there is a gain of the construction of a wing on the plant, which is 1,500, by deducting 17,500 for the lowest bid of the construction and 16,000 for the cost of the construction. But since the addition didn't extend the life of the building, so to record, you just have to debit gain on construction for building addition for 1,500 and credit buildings 1,500. For the same information, there's another entry which is depreciation expense for 317 and accumulated depreciation for 317. This is to correct or to record depreciation on addition of a wing on the plant. We come up with this amount by deducting addition per audit and addition per client. For addition per audit, 16,000 divided by 12 months times 1/2. Take note that company's policy is to take 1/2 years of all depreciations on all assets addition and disposals during the year. So it would be now 667. So for per client, 17,500 divided by 25 years, the estimated service life of the building, times 1/2 is equal to 350. So to deduct 667 minus 350, you would come up with the amount of 317. Third, on August 18, the amount of 5,000 was paid for paving and fencing a portion of land owned by the company for the purpose of using it as a parking lot for the employees, and the expenditure was charged to the land account. For information number 3, you have to record land improvement for the debit account, and since it is charged in the land account, you have to credit land for also 5,000. Also in the information number 3, there is another entry which is depreciation expense for 250 and accumulated depreciation for 250. We come up with this amount by solving 5,000 divided by 10 years, which is the service life, times 1/2, because again the company's policy is to take 1/2 years depreciation on all assets addition and disposals during the year. So it would be equal to 250. Fourth, the amount shown in the machinery and equipment asset retirement column represents cash received on September 5 upon disposal of machine purchase dated July 2009 for 48,000. The chief accountant recorded depreciation expense for 3,500 on this machine in 2017. For the fourth information, just record accumulated depreciation for 20,300 is addition of 16,800. The accumulated depreciation through 2016. This amount is from 48,000 divided by 10 years, which is 4,800 times 3.5 years, which is the remaining life as of 2016. So you would have the amount of 16,800 plus 3,500, which is the accumulated depreciation for 2017. Next is to record debit loss on sale of machinery and equipment, which is 2,000. We come up with this information by cost of 48,000 less accumulated depreciation for 2000 through 2016, which is 16,000, and less accumulated depreciation for 2017, which is 24, because originally the annual depreciation expense yearly is 4,800, but due to company's policy to take 1.5 years of depreciation, you will only have accumulated depreciation for 2,400. So the net book value would amount to 28,000 less retirements or proceeds of sales, which is 26,000. So you will have an amount of 2,000 for the loss on sale. For the credit account, you have to record machinery and equipment for 22,000 and depreciation expense for 1,100, which is from deduction of 3,500 minus 2,400 for the depreciation expense for 2017. Lastly, Cebu City donated land and building appraised at the amount of 100,000 and 400,000 respectively to Haven Corporation. On September 1, the company began to operate the plant. Since no costs were involved, the chief accountant made no entry for the said transactions. For the last information, you have to record first in the debit account land for 100,000, 400,000 for the building, and for the credit account, you have to record paid in capital, which is the addition for the said two amounts, which is 500,000, and also record depreciation expense for 8,000, accumulated depreciation for 8,000. This amount is from 400,000 divided by 10 years, which is the service life of the building, times 1/2. 1/2 is due to company's policy to take half year's depreciation on all assets, addition, and disposals during the year. So you will have an amount of 8,000. That's all for the solutions for audit illustrative case 13.1. Thank you and be safe always.